So, good opportunities, where are they? What do you mean by that?
Yeah, so there's clearly a lot of volatility, but this is still a great time for fixed income in particular. Between the fact that we are looking at potential rate cuts, it's a good time to move out of cash, even though there is some volatility out there, and get into fixed income and really be able to benefit from the capital appreciation when we get those cuts. But on the other side, with equities, there's a lot of volatility, whether it's geopolitical, whether it's politics here in the U.S., whether it's some concerns around unemployment ticking up, and that could certainly disproportionately affect the equity market.
So to that point, a lot was made by the VIX jumping to 65 and the corporate bond spread not blowing out to the same extent that we might have expected. Why was that?
Yeah, fixed income has held in pretty well, and especially the credit markets when you look at the kind of volatility we saw in both the VIX, equity markets, and the like. But I think part of the reason it's holding in so well is that level of starting yield generates a fair amount of income. And from an investor perspective, that income is quite attractive. When you look at it from a historical perspective, it's generating yields that are nearly the 80th percentile. And all the while, we still don't expect defaults to pick up in a material way. So dispersion's high. There's a lot of opportunity to kind of get active and get selective within these markets.
What's still been driving Treasury yields down, though? I mean, is that really about economic conditions, or is this just kind of front-running where people think the Fed is going to go?
I think what we saw on Monday was a little bit of fear, right? As you saw what happened overnight in Japan, and as a result, there was this flight to quality. But I think the market's gotten a little ahead of the Fed at this point, and so again, while we do expect cuts, exactly. We've seen this before, where the market gets ahead and then has to readjust a bit. But I would say September is probably a live meeting.
I know you're primarily focused on fixed income and credit, but when you look at the tea leaves in the fixed income credit space, is that sort of singing the same song as what we're seeing in the equity space, or are we going to start to see more of a divergence in the outlook on equity investors versus fixed income investors?
Equities have had a strong run, and it's been tempting to sort of go in and follow that. But I think the reality of where we are today, and with the volatility that's possible, and like we saw on last Monday, fixed income tends to become that sweet spot of where you can get the upside of, in a multi-sector context of over 7.5% yield, and yet have capital appreciation if we have cuts. And so you have some upside to that, and clearly some downside protection. So, from our perspective, fixed income is still looking quite attractive. Although, there is certainly volatility ahead,
sure,
the starting level of yield can cushion some of that potential spread widening down the line.
Well, then to that point, I was reflecting back on the record issuance of investment grade that we did see last week once things calmed down for a hot minute. You think that the yields will compensate for the flood of supply that we see when things calm down?
I think that highlights also the conundrum from the issuer's perspective, which is, it's better to get financing when you need it, and rather than trying to time it and be so precise. And so, what I would expect, as long as we don't have the same type of high levels of volatility and we've come back in, that we will see issuance. And we've kicked off this Monday also with a fair amount of investment grade issuance and some announcements in high yield and loans as well.
So exogenous shocks, what are you paying more attention to? Is it sort of the U.S. election? Is it geopolitical risks? I mean, oil today spiking by 4%. There's something happening here. What do you pay more attention to, or none?
So I think as fixed income investors, we're kind of always paying attention to all of it.
You're always scared. We get you.
But I do think the reality of what could really change things in a dramatic way would be more the geopolitical risks, because I think on the political side, while at Pimco we make our portfolios kind of stand the test of time and really make sure we're looking through the scenario analysis, so it's robust not just for one scenario or a base case, but through whether it's a downturn or a surprise on the upside. But the real risks where you can get some sort of binary movements really would be around geopolitics. I'm
going to ask you a kind of a stupid question, and it kind of goes to the chart we were just showing, which kind of shows the blowout in spreads. And of course, they were all correlated. The most recent ones were correlated with the recessions that we went through, including the pandemic. How much sort of foresight do you get of that when it's coming? Is it sort of an immediate thing where you just kind of wake up one day and everything's blowout? Or do you sort of get a run up of weeks or even months where you could kind of see that spread widening occurring?
Yeah, it's quite interesting
Yeah.
too right now with the Fed about to cut, and historically we haven't been able to get out of that type of situation
Yeah.
with the soft landing,
Yeah.
and yet that is kind of the base case. So we're sort of always aware of those tails, and in terms of trying to forecast where there could, I would say at the moment we don't see a singular excess that's likely to sort of burst. It's much more around the fact that we could see some concerns around politics, geopolitics, growth, and that can over time. And so, just like the Fed, we're also watching the data closely to see if there's some indications.
Do the elections matter that much? I know equity investors and strategists always say, at least for equities, at least in the short term, really it doesn't have a whole lot of impact. What about in the fixed income space?
Yeah, in the fixed income space, where we're most focused on is obviously, any sort of sweep would have a bigger impact than a divided Congress. But, as I mentioned, since we want the portfolio to be able to perform regardless, what we're often looking at is kind of under the hood. What's the next level of ramifications? And so, for example, areas where we do expect to see policy differences depending on who's in power would be energy, healthcare, financials. And so that's kind of where we're continue to refine positioning and make sure we're kind of being able to capture that upside and have downside protection at the same time.
So what are the favorite sectors right now in corporate credit that you have?
Yeah, so in corporate credit, especially in investment grade, we do prefer financials over non-financials, given the fact that they're serial issuance, they're trading wider than non-financials, and so there's some opportunity there. Within high yield, looking at more of the defensive credits, where the cash flows are a bit more predictable than, say, in wireline retail, where you've got a lot of cyclical headwinds.